As the week draws to a close, we have a look at what next week has in store for the markets. On the monetary front, we note the ECB's interest rate decision on Thursday, followed by ECB President Lagarde's press conference the same day. As for financial releases, we know that on Monday we get China's GDP rates for Q2 and the Eurozone's industrial production rate for May. On Tuesday, we get Germany's CEF economic sentiment and current conditions for July, the US retail sales and Canada's CPI rates both for June. On Wednesday, we get New Zealand's CPI rates for Q2, Japan's Tangan index figures for July, followed by the UK's CPI rates, the Eurozone's final HICP rate, and the US industrial production, all being for the month of June. On Thursday, we get Japan's trade balance figure and Australia's employment data, both for the month of June, followed by the UK's employment data for May, the US weekly initial jobless claims figure, and the US Philly Fed business index for July. On Friday, we get Japan's CPI rates for June, UK's retail sales for June, and the CBI business optimism figure for Q3, as well as Canada's retail sales for May. The USD weakened across the board over the course of the week. On a fundamental level, we note that the calls for President Biden to end his presidential campaign have intensified, yet it appears that President Biden is not ready to give up just yet. On a macroeconomic level, the US employment data showcased a loosening labor market for June, and the release tended to weigh on the greenback. It appears to have overshadowed the higher than expected non-farm payrolls figure. As such, the implications of a loosening labor market could increase pressure on the Fed to ease their monetary policy stance given its dual mandate. Moreover, the US CPI rates for June, both on a core and headline level, came in lower than expected, implying easing inflationary pressures in the US economy, further aiding our aforementioned comment. The big picture tends to be that the US labor market is cooling, as was implied by Fed Chair Powell during his testimony to Congress earlier on this week. Overall, the testimony could be described as relatively dovish in nature, and should further policymakers reiterate Fed Chairman Powell's comments in the coming week, it could weigh on the dollar. The pound is about to end the week high against the US dollar and the euro, yet remains relatively stable against the JPY. On a fundamental level for pound traders, we note that the Labour Party won a resounding majority in last week's elections, having secured 412 parliamentary seats in a landslide victory, which saw the worst defeat for the Conservative Party since its inception. The new UK Finance Minister, Rachel Reeves, seems to be actively pursuing growth for the UK economy and is ready to expand the country's fiscal policy, which could support the GBP. On a monetary policy level, we note that BOE Chief Economist Pill, during an interview earlier this week, stated that the timing of an interest rate cut was an open question. Overall, the implications of interest rates remaining at the current levels for a prolonged period of time may have aided the pound. On a macroeconomic level, we note that the UK's GDP rates for May came in higher than expected, showcasing a resilient UK economy, which managed to expand at an even faster rate than what was predicted by economists. The positive economic outlook for the UK may have further supported the sterling this week. The JPY is about to end the week stronger against the dollar, slightly stronger against the euro, and relatively unchanged against the pound. The relative strength of JPY may have been propped by a possible market intervention of Japan on Thursday during the release of the US CPI rates for June. The Japanese government did not take responsibility for such an operation, yet the strengthening of JPY tends to remain unexplained. Yet on the other hand, the market intervention may bring only temporary relief for the yen, as the fundamentals underpinning JPY's weakness remain intact. For next week, we would like to note Japan's core and headline CPI rates for June, where should they come in higher than expected, implying an acceleration in inflationary pressures, it could increase pressure on the BOJ to adopt a more hawkish stance, maybe expediting the anticipated by the market September rate hike. In such a scenario, it may provide support for the yen, where should the rates come in lower than expected, it may further weigh on JPY. Last but not least, on a fundamental level, we note JPY's ability to attract safe haven inflows in times of crisis, a characteristic that could come into play next week should tensions between China and Taiwan continue to escalate. Common currency is about to end the week higher against the US dollar, but weaker against the GBP and JPY. On a fundamental level, we highlight the second round of the French legislative elections, which saw a surprise victory by the left-wing alliance, which in turn eased market worries for possible win of Marine Le Pen's far-right national rally. Despite this, volatility for the euro remains high as no clear parliamentary majority was gained, which could intensify the political instability. On a multi-level, we know that ECB's interest rate decision is next week, with the majority of market participants anticipating the bank to remain on hold, with EUR/US currently implying a 92.6% probability for such a scenario to materialize. As such, our attention turns to the forward guidance in ECB President Lagarde's press conference following the decision. Should the ECB show that it may be prepared to cut interest rates in the next meeting, as currently expected, it could weigh on the euro. However, any signs of hesitation to proceed with more rate cuts could have the opposite effect. On a macroeconomic level, we note German CEP figures, where should the current conditions economic sentiment indicators showcase an optimistic outlook for the German economy, it may provide support for the euro and vice versa. AUD is about to end the week stronger than the greenback. On a fundamental level, we would like to note that the tensions in the South China Sea between China and its neighbors appear to be intensifying. Should tensions between the US and China also escalate, it could weigh on the Aussie as well. On a macroeconomic level, also given the close Sino-Australian economic ties, the better than expected imports rate from China for June, which came in at 2.8% year on year, may imply that demand for raw materials from Australia may have increased and thus could have aided the Aussie. In the coming week, we highlight the release of the Australian employment data for June in the event that the Australian employment data implies a resilient labour market. It may increase pressure on the RBA to enhance the possibility of a rate hike, which in turn may aid the AUD. Lastly, we would also like to note China's GDP rates for Q2, which are set to be released next week. Hence, with a GDP rate for China expected to come in lower than the prior rates, could imply economic activity in China may be slowing down, which in turn could weigh on the Aussie. The loonie is about to end for a fifth week in a row stronger than the US dollar. On a macroeconomic level, we note that Canada's unemployment rate for June, which was released last Friday, came in higher than expected at 6.4%, implying a loosening labour market, which tended to weigh on the CAD following its release. Yet, the IV PMI figure for June, which was vastly exceeded expectations, appears to have mitigated the negative impact on the loonie. For next week, we would like to point out the release of Canada's core and headline CPI rates for June. Should the CPI rates imply an acceleration of inflationary pressures in the Canadian economy, it may increase pressure on the BOC to adopt a more hawkish stance, which may aid the CAD. On the flip side, should the rates come in lower than expected and thus imply easing inflationary pressures, it may have the opposite effect. Interestingly, oil prices seem to have halted their ascent since last week. As such, should they decrease in the upcoming week, it may weigh on the loonie given Canada's status as a major oil-producing economy. Overall, in the coming week in the FX market, we expect the USD to maintain some initiative over other currencies, as some financial releases from the US could be considered of high impact. Yet the overall attention on Thursday may turn to ECB's interest rate decision. As for US stock markets, we note that all three major US stock market indexes, that would be Nasdaq, S&P 500 and Dow Jones 30, were on the rise for the week in a signal of increased confidence and optimism, with the S&P 500 and Nasdaq forming all new time highs once again. As for gold, we note that the negative correlation of gold prices to the USD seems to have resumed to gold's favor. It should be noted that despite the relative stabilization of US yields during the week, the CPI print for the US on Thursday seems to have turned the tide against gold sellers. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So, as per usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. So I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We're going to start off with a really quick intro to stochastic oscillators, in case any of you guys haven't used it before. And then we'll talk a little bit about RSI because they are pretty closely related. And then we'll compare the two, followed by some divergence trading. So if you guys are unfamiliar with divergence trading, we'll definitely go through quite a few examples in this webinar. And if we have time at the end, I will take some requests as well for any charts that you'd like me to go through. Yeah. So let's go ahead and get started. Wait, let me just make sure you guys can see me. Okay. So how exactly do you use your stochastic oscillator? So wait just a second. Okay. So what exactly it is, firstly, is that it consists of two lines that fluctuate between 0 and 100. So the first line is called your K line, and it represents the current closing price of the instrument in relation to the high and low prices of a given period. The second line is called the D line, and it's basically the moving average of K over a certain number of periods. So I have a pretty more in-depth explanation of it here on the slide if you are interested in that. So the slow stochastic indicator, which is your D, is a 3-period moving average of K. Difference between the slow and fast stochastic oscillator is the slow K, which incorporates a K slowing period of 3 that controls the internal smoothing of K. So setting the smoothing period to 1 is equivalent to plotting the fast stochastic oscillator. So the fast stochastic oscillator is basically your K line that we mentioned earlier. Okay, so how do you use it exactly is basically for us, we will use the settings that are 533, the readings that are greater than 80 indicate that price is near its high. Readings that are below 20 indicate that prices are near the lows. Okay, so a security is overbought when K moves above your 80 line, and a security is oversold when K moves below 20. So I've included the formula for the stochastic oscillator as well in case you were curious. But most of the time when you're using this indicator on your MT4, MT5 on TradingView, it's normally calculated for you already. So this is just like FYI. Okay, now let's talk a bit about its pretty closely related cousin, which is your RSI. Oh, I also wanted to mention earlier that your stochastic oscillator is a momentum indicator, but it doesn't provide information about the direction of the trend. It's also a lag, means that it relies on past price data, and it might not be so effective in predicting future price movements on its own. So that's why we often will use stochastic oscillators with other indicators or Fibonacci levels and so on and so forth. Okay, about RSI, because these two, we normally will use them together. So what is RSI? It's basically a measure is to measure the strength of the price action over a specified period of time, commonly used to identify potential entry and exit points in the market. Your RSI also measures the magnitude of a security's recent price changes to determine whether it's overbought or oversold. Okay, so how do we use that? So it basically oscillates between 0 and 100, with values above 70 considered overbought and values below 30 considered oversold. So when the RSI value is above 70, it suggests that the security might be overvalued and due for a price correction, potentially indicating a sell signal. When the RSI value is below 30, it suggests that the security may be undervalued and due for a price rebound, potentially indicating a buy signal. Okay, so people use RSI in combination with other technical analysis indicators or your fundamental analysis as well. So that's why we want to talk about both RSI and stochastic together. Okay, so let's compare the two. So they are both price momentum oscillators that are widely used in technical analysis. And while they're often used in tandem, they each have different underlying theories and methods. So the stochastic oscillator is predicated on the assumption that closing prices should move in the same direction as the current trend. Meanwhile, the RSI tracks overbought and oversold levels by measuring the velocity of price movements. So in other words, the RSI was designed to measure the speed of price movements, while the stochastic oscillator formula works best in consistent trading markets. So yeah, so we would generally use your RSI in trending markets, stochastic more so in sideways or range-bound markets. Okay, so this is just an example of what your RSI and stochastic looks like. This is on TradingView. You can see it's pretty similar in terms of the price movement. So whenever we are expecting prices to drop, they tend to have a pretty similar price movement and price structure as well. Okay, now let's get into one of the biggest strategies that we use for stochastic and RSI, and that is divergence. So divergence in trading is basically a technical analysis concept that compares the movement of a security's price and an indicator, such as an oscillator that we're talking about here, to identify potential trend changes. So there are two types of divergence, your bullish and your bearish divergence. So I have some examples here of bearish and bullish divergences. There are regular, hidden, and exaggerated divergences, but let's firstly focus on our regular divergence. So your bullish divergence occurs when the security's price makes a lower low, while the indicator makes a higher low. So this suggests that the downward momentum of the security is losing strength and a potential upward trend may emerge. Bearish divergence, on the other hand, occurs when the security's price makes a higher high. So this suggests that the upward momentum of the security is losing strength and a potential downward trend may emerge. So it's important to note that divergence is a potential early warning sign of a trend change, but that's still not a guarantee. Okay, so that's why we would use this in combination with your trend lines or chart patterns to confirm a divergent signal before making trading decisions. Okay, so you can see the higher high that we're talking about for bearish and the lower high, lower low, higher low on our bullish. Okay, so now let's take a look at some examples. I think we have a bunch of examples to go through. Yep, so if you guys have any questions, feel free to just pop them into the chat. Okay, so first example, we have price testing a key horizontal resistance level with price making a smaller high, resulting in bearish divergence with the RSI. On our RSI, you can see a descending resistance line forming, and it caught the past two reversals correctly. So it forecasts that we could be seeing a reversal here. Okay, and the bearish divergence, you can see a higher high and a lower low here. A lower high, sorry, on our RSI. So you can see after that, that price reversed strongly because of three factors. Firstly, the horizontal resistance, the RSI resistance, and lastly, the bearish divergence. Okay, and that similar thing happened on RSI as well, where RSI reversed very strongly off of the resistance, the descending resistance on our RSI. Okay, and now another example here. This one's pretty straightforward. When price is making a higher high and stochastic is making a lower high, that is a bearish divergence. So pretty straightforward, and we are expecting prices to react off of that same area, which it did here. Okay, and it's also giving us a repeated pattern with our bearish divergence again, with price making a higher high, and stochastic giving us a lower high. There is also a hidden resistance level here. So you can see on our stochastic, these two peaks line up in this horizontal dotted line. Whereas on our price, you can see very clearly that price made a higher, price moved upwards, basically. So you can see price reversed very strongly after that bearish divergence. Yeah, and also after the hidden resistance. Okay, so this is the levels, or rather the areas that we're looking at. Here you see price making a higher high, stochastic kind of maintaining at this level both of these times, and that's basically called a hidden resistance. So hidden resistance is when our stochastic or RSI or whatever oscillator indicator you're using, basically at the peaks line up to give you a horizontal resistance level, whereas on our price, you can see very clearly that the peaks don't line up. Okay, I think that's pretty straightforward. So let's look at another example. Here we can see that prices are moving in an ascending trend line, whereas on our stochastic, it's maintaining at this hidden support level. Okay, we have a stop loss here, your entry over here at this overlap level, and we're going in for a buy towards our take profit at this swing high here. Okay, so ultimately, this is the result of that, where we are expecting price to bounce off of the ascending trend line. So firstly, we have the ascending trend line. Secondly, we have the hidden resistance. Yeah. Okay, and that's exactly what happened here. Bounced off nicely and headed upwards towards our take profit. Okay. Okay. Now let's take a look at divergence potential. So in this example, we have an overlap level. Okay, overlap level is basically when there are swing highs, as you can see here, and a swing low that line up in that same area. And it just means that the bulls and bears respect that area. Okay, so we want to take note of where the bearish divergence started. So as this is the level that it will tend to reverse to. So you can see it started here, and our RSI is making a lower high, whereas on price is making a higher high. So we have a bearish divergence, price is making, yeah, that's basically what I just said. And we are expecting price to rebound to that same level, also because of that overlap level that I mentioned earlier. So we have two factors now coming to play, your bearish divergence and your overlap level. Okay, and you can see that's exactly what happened. Price reversed nicely back down to where the divergence started to occur. Okay, so that's why we always say not to use any one specific method or one specific method like your divergences that we've been going through, or one specific indicator like your RSIs. That's why we always use a combination of them, like your graphical methods, which is what I just mentioned about the overlap levels or pullback levels, swing highs, swing lows. Those are graphical, or your Fibonacci levels as well. And use those in combination with your divergence, potentials, hidden resistances, and indicators, just so that it confirms your signal before you go in for the trade. Okay, and forecasting breakouts. So you can also use divergences to forecast your breakouts. And one way of doing that is by using your RSI or stochastic indicators. So firstly, in this example, we see that the RSI broke out of this ascending support, highlighted by this dotted line. So it broke out of it, even though on our price chart, it's giving us, it's showing that price is continuing in that same, I guess, ascending trend line. Okay, so that's the first point. Second point is that price is barely breaking out of the ascending support line. If you look really closely, you can see it kind of just peeking out below it. But it shows a strong recent bearish divergence versus RSI. So you see price making a higher high, whereas on our RSI, it's making a lower high. So that's your bearish divergence. So we have 3 points now, the RSI breakout over here. Secondly, we have a bearish divergence. And lastly, we have price just breaking out a little bit. So it suggests that there is a high probability that price is going to break out of this ascending trend line. You can see after that price broke and dropped strongly. Okay, so just as we expected, price right after this bearish divergence, price broke out of it and dropped strongly from this trend line. Okay, any questions so far? Okay, if not, let's look at another. We still have a few more examples to go through. Before, if I still have time at the end, I will do a little bit of live analysis for you guys. Okay, so next we are looking at this RSI breakout again. What's the best time frame to use divergence? So, actually for divergence, we normally would use on a mid-range kind of time frame, so like your 1 hour, 4 hours, or even your daily time frame, just so that there's more time for you to see, kind of how the price plays out. Yeah, and also because on the shorter time frames, like your 5 minute, 15 minute, and 30 minutes as well, that kind of it's a bit it tends to have a little bit too much noise for you to actually see the divergences. because price is constantly moving. Yeah, so to answer your question, H1, H4, and daily time frame. Probably wouldn't go more than daily time frame. Yeah, no worries. So what was I saying? Yeah, so on our RSI here, we see RSI breaking out of the descending resistance. And we're calling it a resistance instead of a descending trend line because for it to identify as a trend line, it needs to touch at least 3 times, which here you can see it hasn't. So that's why we're calling it a resistance level. So now price is now testing this descending resistance line, and we're wondering if it's going to break out of it. Okay, so that's our first point. Excuse me. Our second point is that there is a descending line breakout of our RSI. Excuse me. And lastly, there is a recent bullish divergence, which suggests that we could be seeing a strong reversal. So over here, we have price making a lower low and RSI giving us a higher low. So that is a sign that a bullish divergence, or rather that is a bullish divergence, and it could be a sign that we're seeing a strong reversal. Okay, so you can see after that there is a successful breakout of the descending resistance line as forecasted by our RSI. Okay, here is kind of a GIF for you to visualize what we are talking about by bullish divergence. So in this bullish divergence, we are using RSI as our indicator. You can see price making a lower low, and our RSI making a higher low, which is a bullish divergence. That in combination with our resistance level here, that's also in line with a swing high and also a 100% Fibonacci projection. Okay, yeah, so as you can see in the GIF, continued, price actually broke out of that descending trend channel and it reversed off of that resistance line. Okay. Okay. Another example for bullish divergence. Here's a little bit smaller. You can see price making a lower low, RSI making a higher low. Another point is that RSI is actually moving below um, below 30, okay, which is, if you remember earlier, that is a sign that price is oversold. So it could be a sign that price is going to rise again. So you can see after this bullish divergence, price did continue to rise. Okay. Yeah, that brings us to the end of my slides. Um, Let me just pull up my trading view and we can take a look at some charts and see if we can identify any divergences. Okay, do you guys have any requests for any charts? Mm, okay, if not, we can go ahead and take a look at AUD first. Okay, so on our weekly time frame, you can see prices kind of moving in this downtrend. But on our daily time frame, we see prices generally moving upwards. Okay, I think we might have prices moving in a trend channel. Let's see. Okay, not really. Okay, but it is generally moving upwards. Okay, no. Okay, so going in with our support and resistance levels first, I'm gonna place my first resistance up here and my pivot over here. Okay, this is my first support. Now I'm going in with my Fibonacci levels. Okay, my 61.8 lines up. I'm also gonna place okay, actually no. I'm gonna move my pivot here. Okay, because it's a double swing low and also it's in line with our 38.2. Okay, now I'm going in with a Fibonacci extension. Okay, and my 127 lines up with my first resistance. Okay, so for that, we used this Nike tick shape that you see here. Let's see if we have any projections. Okay. Okay, my 78.6 also lines up with this first support. So this area here is our confluence area, which is basically when two or more Fibonacci levels line up nicely. Okay, that's our confluence area. Okay, my 61.8 kind of lines up with my first resistance as well. So for confluence areas and Fibonacci levels, they don't really have to line up exactly at your horizontal levels. As long as it's kind of near it, that's good enough. Reason being that price tends to be attracted to these areas, but it might not be able to pass through them or break out of them rather. Okay, so as long as you kind of get it's kind of around the same area, that's good enough. Okay, now let's look at some indicators. I like to start off by looking at Ichimoku and MACD because it's easier to see at one glance what your signals are. So now Ichimoku, it supports our bullish signal. MACD is not supporting our bullish signal. Okay, on our stochastic, let's see if we have any signals here. Okay, here it's not really telling us much. Let's look at RSI. Okay, on our RSI, we have prices moving in this uptrend. Sorry about that. Okay, sorry about that. So, where were we? Yeah, so we have prices moving in this ascending trend line. Okay, it's not really a trend line like I mentioned earlier because we need 3 touches on it, but it is a resistance level. So we are expecting prices to continue upwards here. Since previously it also continued upwards. Okay, it also caught that bounce. Okay, maybe yeah, do you guys have any questions or any charts you'd like me to go through? Hmm, if not, yeah, I guess that's it for today's webinar. Thank you guys so much for joining me. I hope you guys found this session helpful. And if you guys have any questions or anything, feel free to pop them into the chat. I will still stay around for a while more. And yeah, but if not, you guys can go ahead and leave the session, and I'll see you guys again next week. Thanks, everyone. Yep, this session is being recorded. I'm not too sure where they're gonna post the video. So if you want, you can email IronFX. Yeah, you can just email them and ask them for the recording because it is currently being recorded. Yeah, just ask them and I'm sure they will help you out. Okay, yeah, thanks everyone. Bye.